All right, we're ready for Module 6, Part 1, and we're going to look at W-2s. We're also going to look at state and local tax a little bit more in depth. And then in Part 2, we're going to check out this new item that's been proposed and thrown around for the last several years. It's not gaining a lot of traction yet, but it is gaining traction, and it's called the fair tax. And I think it'd be one of the first times you've probably ever heard of it. And it's interesting to see what everybody thinks about it, because there's a differing opinion. But first, when we starting out here in Part 1, what I want you to do is these 16 items. You should know these are items that I would want you to take away from this class, and things that are going to be important for our individual assignments and then into the final. So take the next 10, 15 minutes and go through these and answer them and see, and then we're going to see how you do. We're going to go through the answers. So go ahead and pause now. All right, hopefully you have everything, all of these answers done. Let's go through some of the answers. On the first one, 3 fringe benefits, there's a whole bunch of them, and you can go back to the notes, but a couple of big ones, the de minimis. That's those small little items. If you get some reduced or free tuition, that's a non-taxed fringe benefit, no additional cost services. What payroll deduction is taken for federal income tax, but not FICA? That one is your retirement withholdings. So when you have money taken out of your paycheck for retirement, it's not taxed for federal, but it is taxed for FICA. List 3 specific employer payments that are not taxed. And again, you can go back to last module, and here are just a few. Here are some of them. This is not an exhaustive list, but to give you an idea of some non-taxable payments that you could receive, or some benefits that you could receive that would be not taxed. All right, who pays federal income tax? Hopefully we know that by now. That is the employee only. Which form is filed for the FICA and federal? We better know that one by now, Form 941. When are FICA taxes and federal income deposits made? Well, it depends. They're made typically either bi-weekly or they're made monthly, depending on the look-back period and how much is collected during that past year. Are wages received from workman's comp taxed? The answer is no, they are not. Are unemployment wages taxed? And the answer is yes. Which payroll deduction has a use it or lose it rule? Well, that's going to be your flexible spending account, the FSA. When you put money aside for medical premiums or dependent care, you need to use it or it will be gone for the next year. What are 2 typical amounts based on age allowed to be deducted for an IRA contribution? Well, the 2 typical amounts, as long as you don't hit the cap, are $6,000 and $7,000. What is the IRA phase-out range for someone with no company 401k plan? If you don't have a 401k plan, there is no phase-out range. I would never expect you to memorize phase-out ranges. Which form is used to determine how much federal income tax should be deducted from each pay period? So which form? Well, that's publication 15T. And where we get the information to fill out that form is from the W-4. Writing exempt below line 4 on the form mentioned above will do what? Well, that'll make sure that you have no federal income taxes taken out. You'll still have FICA and state, but not federal. What is meant by the marginal tax rate? Well, that's where your last few dollars are being taxed at that highest percentage. And if you would make $1 more that year, you're going to be taxed at that percentage. How many marginal tax rates are there? There are 7. They change maybe every 4 to 8 years. There could be some changes depending on presidential cycles, things like that. But right now there are 7, and there have been 7 for quite some time. And what is the difference between a marginal and an average tax rate? So the marginal is what your highest rate, your most recent dollars are taxed at, your last few dollars. The average rate, because not because some of your earlier dollars are taxed at the lower rates. So the average rate is basically your total tax divided by your total taxable earnings. All right. I go ahead and go through lecture example number 1. This is a review from all of last week's information. So you'll want to go ahead and pause and then check the answers. we're not gonna go through all of these answers. This will take a little bit longer to do. You can set up a time with your instructor to go through these. That would be a very good thing to do, especially if you're not getting some of the answers. But go ahead and practice this, and then check your answers with those that are attached. All right, going into our new items, this module. First one, we're all familiar with the W-2. Now what we're gonna do is kind of look at the finer points of it, and so you know exactly what's all on the W-2 and what you can do with it, if anything. All right, so the first thing to know is employers are required to send out a W-2 by mail or by have it available through their website by January 31st. They can file an extension, but and if you would file an extension, I think they have to let the employees know by then as well that an extension has been filed, because for some reason they can't get it done. But typically you should get your by January 31st. That's when they have to be mailed. So it could be another a week or so for it to go through the mail. They have to send you a W-2 if you had any federal or Social Security taxes withheld, or you would have had federal taxes withheld if you did not write exempt. So those are the 2 criteria. If you meet one of those, you will need to get a W-2. The employer is going to need to keep those W-2s for at least 4 years to meet the statute of limitations for that item. All right, so I've got a W-2 in our learning activities there. You may want to pull it up and follow along. And I'm going to pull a copy up at this point as well. All right, so we've got a W-2 here. This is down on page 3. When you pull it up, they're all going to look like this to start out, all the forms. And then I like to come down to the nice black one. It's easiest to read. W-2s don't all look identical, as you may have noticed from if you've gotten more than one W-2 in a year. Some of them are a lot like skinnier, up and down. They all have information in about the same areas, but they're by no means in exactly the same areas. Some of them that are more skinny and up and down have the employee's identification number, their Social Security number. It's sometimes like stuffed right in the middle. It can be somewhat difficult to find, especially when you're preparing taxes. But somewhere they are going to have the Social Security number. They're going to have the employer identification number. They have to have one of those. And then the other just normal name and address for a company and employee. All right, so we get down to box 1. Box 1 is your total federal taxable wages. So just because when you look at your W-2 when you get it at the end of the year and you see, oh, it says 36,000, that must be what I make. That's not necessarily true. You could make more than that. It won't be less, but you could make more because some of those items that you had taken out of your paycheck aren't going to be included in box 1, like your medical insurance premiums or your 401k or any other retirement deductions. They're not included in that 36,000. So perhaps you actually have earned 39,000, but what's actually taxable goes on your 1040 is the 36. So the lower the number compared to what you actually make is better. So you want to have some different, so you're not taxed at that higher rate. This is a yearly amount, of course, it's a yearly form. Box 2, this is the only item that's on your W-2 that you will get a refund potentially from. You could get more than that, or definitely less, but this is how much was taken out in a best guess to how much you owe to the federal government for the entire year. So it could be $4,000, but when you fill out your 1040, maybe it says you only really owed 3,000. So then you're going to get that 1,000 back because you overpaid through your job withholdings. So if your 1040, when you fill it completely out, says, okay, you owe 3,000, but you paid in 4, that's where you get some money back. And you could get more back depending on if you qualify for any other refundable credits. One of the biggest ones is the earned income credit. That's not part of the W-2. That's on your 1040. If you go on and do a tax class, we'll learn a lot more about that as well. All right, so we got box 1. Everything over here in boxes 1, 3, and 5 are all taxable earnings. Everything over here on the right side, 2, 4, and 6, are all the actual tax amounts that are taken out of your check for the whole year. So boxes 3 and 5, most of us who aren't a doctor or a highly, highly paid individual, our boxes 3 and 5 will always be the same because we're not going to hit the Social Security cap. The only time boxes 3 and 5 are different is if you make over the Social Security cap for that year. And for this year, we all know it is $142,800. So if you do make more than $142,800, that's going to stop right here. Box 3 will stop at $142,800, the cap. Box 5 will keep going to show how much you actually made for Medicare purposes, and no cap. All right, so most of the time 3 and 5 are the same. Box 5, no cap. There are a few instances, or let's take a step back, steps 1, 3, and 5, boxes 1, 3, and 5, for a lot of people will be the same. Boxes 1, 3, and 5 could all be 20,000. And basically that tells me as a preparer, if they're all the same, A, you didn't make over the cap, and B, you didn't have any federal taxes taken out. No, you didn't have any retirement withholdings taken out. When you have retirement withholdings taken out, that's when boxes 3 and 5 are going to differ from box 1. And that's what I have up here. Your withholdings for retirement are going to make box 1 different. Otherwise, boxes 1, 3, and 5 will all be the same because they all have all the other withholdings taken out. So even if you made $39,000, but you had medical insurance premiums of $3,000, so that brings you down to 36, and that's all you had taken out for your paychecks, you would have 36,000 for each of these boxes, even though you really earned 39. All right, let's keep going here. We're not going to use in our class here box 7 or box 8. Box 10, this is more of a for tax class. We use this one, but that's just to let a tax preparer know, or you know, how much money did you put away for dependent care through your FSA account, and then to make sure that you actually spent that money. Because if you haven't, then it's going to be taxed on you. Box 12, you can see there's different codes. You can have different amounts, and you can actually have more than 4. You could have as many as there are. If we go to the very bottom, not the very bottom, but if we keep going down on the W-2s, box 12 has different codes. They start here, and you can see they go A through E, and then they keep going F through AA all the way down to HH. So there are quite a few codes that you could potentially use. The most common are D and E. D and E are your retirement withholdings. So it's going to say D if you have this type of withholding, E if you have a slightly different type of plan withholding. And then the other common one is DD. And this is how much your employer put into your health insurance account. Basically, that tells the tax preparer, and this was a couple of years back when it was required that you had health insurance. This tells the employer that yes, or the tax preparer that yes, you definitely had health insurance, at least for part of the year. Then you would just ask them if they had their position all year and had health insurance. But that's not applicable right now anymore, unless that would ever come back. That health insurance is not mandatory like it was for a couple of years. All right, back up here at box 13. the employer will check this box right here, the retirement plan, if they actually offer you and pay into a retirement plan, or you have the option for you to put in and for them to match. Remember, that's for the IRA purposes, to see, do you have the option of a 401k plan? And then if so, you start having phase outs. If you're a statutory employee, remember, those employees have FICA taxes taken out, but not federal. So that would be checked perhaps. And then if you are out and you have this long-term like sick pay, disability, this potentially could be checked, but you don't see that very often. Box 14, nothing is required to go in there. That's just extra information if the employer wants to put anything in there that could be helpful to you, but nothing goes in there. Anything there does not go into a tax return, or it's just extra information. And then finally down here, boxes 15 through 20 are for state purposes. The key boxes 16 and 18, they are going to be the same for Indiana purposes. That's just, and they're going to equal your box 1, the federal wages. So that's just how much wages are taxable for state and local. And then 17 and 19 are how much taxes did you actually have taken out. And these are the state amounts that you could potentially get refunded back to you if you overpaid for state and local. And then 20 shows which county are you in. That's not really needed for tax purposes, because when you're going through, you ask the person, as part of like the standard questions, which county do you live in? So it doesn't really need to be on your W-2, but it is. Every state's a little different, so some states it may be more necessary. All right, let's look at a W-2 example. And I wanted to show you an example where boxes 1, 3, and 5 would all be different. Where boxes, the federal taxable wages, Social Security wages, and your Medicare wages would all be different. And this would be a prime example. If we have gross wages of $150,100, and then we have these 2 deductions throughout the year, that would cause us, and see what you get. Go ahead, and it shouldn't take you more than a minute. Pause, and then figure out what you would get for boxes 1, 3, and 5. All right, let's see how you did. If you haven't, quick pause real quick. All right, boxes 1, 3, and 5, here is what they would be. For box 1, we can take out from our gross yearly wage the 401k withholding and the medical premiums for medical insurance. So when you subtract those 2, you get 141.1. For boxes 3 and 5, we cannot subtract the 401k. We can only subtract the medical premiums. So that brings us to 146.1. And typically boxes 3 and 5 are the same, except if the cap has been exceeded, and it was. We can't have box 3 over 142.8 for this year, for the tax year of 2021. So this would be an example when your 3 boxes would be different. So you're not going to see that very often, especially unless you have some especially high wage clientele. All right, lecture example number 2. I want you, and this is going to really see how you do. I want you to fill out boxes 1 through 12. You don't have to do the state part, and see what you get for each box, except you're not going to do boxes 7 and 8 and 9 and 10 or 11. You're going to do basically boxes 1 through 6 and 12. And let's see how you do. Go ahead and pause now for lecture example number 2. Okay, for box 1, you should have got 43,000. If you take your annual salary and then you start deducting the items that are allowed to be deducted. So we deduct, yep, you can take out 4,200. Doesn't matter that the employer paid into it. That's great. But for our purposes right now, that doesn't matter. We can deduct the 401k deductions. Doesn't matter that the employee matched it for this purpose. We can deduct Actually, so this is going to be in box 10. So I didn't say box 10, but this would go in box 10. We can deduct the 1,500. We can deduct the 2,500. We cannot deduct the 5,000 in child support dues. That's just a deduction that we don't get to take a tax benefit from. So box 1 would be 43,000. Box 2 will be the longest calculated answer that we have. We're going to have to know this. This is why I gave us this information. You might be thinking, why in the world did you give us last week's stuff? Well, we have to know this in order to calculate how much taxes are taken out each pay, and then ramp that up to a yearly amount. Okay, so what we're going to do for box 2 is this is going to be by far our longest answer. So if you didn't do it, go ahead and do it. Let's talk through it, and then I want you to pull up the correct forms. I've given you the annual salary, but we're going to want to break it down into semi-monthly because that's when they're paid. So we're going to divide the 55.2. There are, for semi-monthly, if you're paid twice a month, that means there are 24 pays in a year. So our taxable wage, oh, sorry, we don't want to use 52,000. We want to use this number. 43,000 divided by 24 pays. Remember, I don't want to use 55.2 because that includes everything that I earned, doesn't take away all of these deductions. That's why I want to use 43,000. So we're going to have 1,791.67 as our starting amount. And then you're going to pull up your W-4. You won't actually need the W-4 for this one. And publication 15T. We won't need the W-4 because we are married, but step 2 is checked. So that means husband and wife make about the same amount of money. And we can just use publication 15T for that. All right, let's go through. Go ahead and pause right now using this as your semi-monthly wage. And so let's see what you get. All right, I really hope you took the time to pause because this is the only way you're really going to know if you understand this stuff and to find out where you're still lacking. I wouldn't wait to actually doing it on the homework to see if you've actually understood it or not. So if you still have it, do it now. It's going to really help you. All right, box 2. All right, the final answer here was this. That's how you know if you got it right or not. But let's see how we went about getting that answer. All right, so again, I told us we started with the 1791. Then when you look at the publication 15T and you look to the right side of it, because the box 2 is checked, so that's important. We got to look to the right side numbers. We're almost always looking at the left side because they're not checked. This box 2 is not checked. We're going to go down to the semi-monthly area. And when we find this number, we're going to subtract out $938 from that publication 15T. Take that amount times 12%, that's their marginal rate. And then take the 102.44 plus the stated amount of $41.50. So this is our base number to go off of for federal income tax, but we still have one more item to do. It says we have 2,000 listed there in step 3. Remember, you take the 2,000 and divide it by how many paychecks they're going to have for the year. So 2,000 divided by 24 pays, 83. And then we want to take our base amount minus the 83. This is what their per check is taken out, $60. And then we just want to ramp that back up to a yearly amount, $60.61 times 24 pays. And that's how I got to the $14.54. So by far, that's the most calculating answer. It takes the longest time. You would have already been doing all of these all along if you were doing a typical payroll register, but we just had to go ahead and do it from scratch because we didn't have any of that information. All right, box 3. Box 3 is going to be almost identical to this, except we're not going to take out the 4,000 of 401k. So it's going to be 4,000 higher. So box 3, you should have 47,000. Box 4, you're simply just going to take that 47,000 times 6.2%. Because that's how much you should have taken out for Social Security. Box 5 is going to be the same as box 3. And then multiply that by 1.45. And then we're going to skip down. Box 10 is the dependent FSA, 1,500. And then finally, box 12, how much did we have taken out for 401k? 4,000. So we would have code D for box 12. And then code DD would be this amount here, the 5,500 that the employer paid in for medical premiums on our behalf. It's how much they paid in. Okay, so hopefully you, if you didn't get all those answers, you now understand, because we're going to have some items like this on our homework in the final, in the project about W-2s, because making a W-2 and understanding where those numbers come from is a very important part of payroll. All right, a Form W-3. The Form W-3 is a summary of all of the W-2s that that employer gave out. Okay, so a W-3 is going to look very, very similar to a W-2. It's going to have box 1, but instead of it being per employee, you're going to have box 1 added up for all of the employees. So it could easily be in the hundreds of thousands of dollars or millions of dollars based on how much payroll that company does every year. And that's going to be the same for all of the amounts. It's just a summary of everything the employer provided. They have a little bit longer to make this. I don't know why they need the extra, all that extra time, an extra month, because it's once you have all the W-2s done, that's the hard part. Some other forms that you should be aware of in the payroll world. The first one here, the first two are, we used to use only the 1099 miscellaneous. This one didn't even exist until 2020. We would use this to show independent contractors. If companies paid independent contractors over $600, then that company was required to provide a 1099 miscellaneous to that contractor. And it looked like this form. They, in the past, before 2020, box 7 would have had an amount here that said non-employee compensation. And then there would have been an amount that they could have put. So non-employee, meaning they are an independent contractor, and how much they were paid. Now, a lot of businesses got confused and tried to put it up here as other income. And that's not correct. Other income would be for items maybe like you won a radio contest, a radio competition, and you won a free vacation. That other income would have gone here. But if you're actually working for them for the amount, then it would have went down here in box 7. To avoid that confusion, then they created this non-employee compensation form, a form just for basically line 7. It said, okay, how much did the non-employee get paid? And did you take any federal taxes out? Perhaps you did. Most of the time it will be no. So that's the difference between those two forms. This is what companies will use from 2020 on. Notice it's only companies that have to provide this to other independent contractors. if me as an individual, if I would hire a company to come out and put a new roof on, they may be an independent contractor. They do it on the side as a small little business. I don't have to provide them a 1099 NEC. It's only for companies. And then the second part of that, companies that pay over $600 to that individual for a service. So as you can see, if you have a bunch of small clients, you have your own business and you have a bunch of individual clients and they're pretty small, it's a very good job that it's a very good chance that none of your earnings would actually ever be reported to the IRS. So they have no way to really know how much you earned except by doing an audit of your bank account if you got paid a lot of checks. But then that gets even harder if you're paid cash. So I've known some companies, they came and did work for us and they gave us two prices. They said, if you pay by check, it's $100. If you pay us in cash, it's $90. And that tells me right away, if I pay them in cash, they're not going to report it. And they're going to save that money that they would have otherwise paid to the IRS. And so then they're going to pass that savings on to me. So they were hoping that you would pay in cash. If you ever win any lottery or casino winnings, you're going to get a W-2G. You can look that up to see what it's like. And a couple other forms here, dividends and interest, 1099s. 1099 is a very common form number. It's just, you got to know what is after it, like a 1099-R. That's when you take money out of your retirement account. You're going to get a form that shows how much you had taken out and then if they took out taxes as well. And then finally, just like a W-3, the W-3 was a summary. The form 1096 is a summary for all of the 1099s that are out there. So all of these, you would have your own, each company would have a 1096 for any one of these that they provided as a summary. All right, if you need to take a quick break, now would be a great time because we're going to jump over and we're going to look at state income tax. So I'm going to pause just for a second myself and get a drink. We'll be right back on the same video. All right, state income tax can be interesting in itself because of how states tax and how different states do taxing differently. First thing is way back to module 1. We're kind of clamping down here on the rate. Definitely is, again, we want to memorize for Indiana, 3.23% is the state rate. And states, all the states, they base your taxes on where the services are performed. And so this comes, and we'll see where this comes into play, and it can be quite havoc for professional athletes. Because just because you're based out of the Los Angeles Lakers and you're in California doesn't mean you only pay California taxes, because you're performing your services all across the US. So we're going to get into more of that below. Now, states based it on where you're at when you perform the services. Indiana counties are just the opposite. Indiana counties base the tax when you have taxes taken out based on where you live, not where your employer is located. So you may actually travel to, say, Indianapolis and in Marion County, but you live just north in Noblesville in Hamilton County. Well, you would be taxed at Hamilton County rates, not where you work in Marion County. There are 9 states that actually do not collect state income tax. And I've listed these here, and these are actually going to be part of your discussion board this week. You can get in, you'll look into that to see more details. Florida is a very advantageous place to live just because it's not a huge savings compared to Indiana. I mean, Indiana, they're going to tax you an extra 3.23%. So when you live in Florida, that's what you would expect to save. Now, the cost of living in Florida is more than this amount of savings that you get. So you're not really saving, but it's a little bit of tax savings that you get. If you wanted to see what the Indiana state form looks like, if you've forgotten, most of us have an idea of what the 1040 looks like for federal, because we see that all the time. The state income tax, I have that here for your reference if you are interested. Now, a big question that comes up is, and especially for those of you in the state that live near the borders, well, what happens if my job is in a different state? And that comes up quite often. In this example, let's say you live down in very southern Indiana, Jeffersonville, or somewhere right around there, and you work in Louisville, just across the border. Do you have to pay tax in both states? And the answer is no. The states on the border, they typically have what's called a reciprocal agreement. And a reciprocal agreement says for any people that switch over state lines for their job, you keep the ones, Indiana state, you meaning Indiana, you keep Indiana people that actually live in Indiana, and us, Kentucky, we're going to keep the Kentucky people that live in Kentucky, even though they may work in Indiana. And for that to be equal or somewhat equal, you've got to have two similar sized cities on each side of the border. So Kentucky has Louisville, Indiana has Evansville. And I don't know the population's exact, but they're probably somewhat comparable. And people from Kentucky are going to come across and work in Evansville, and then vice versa. So we can easily do that with Kentucky. With Ohio, it's not quite as the same, but the two comparable cities would have to be Cincinnati and Fort Wayne. Now, Fort Wayne isn't nearly as close to the border as Cincinnati is really close to the border, but there probably are still plenty of people who live in Ohio and do make the trip over to Fort Wayne. It's not that far. Us in Michigan, I'm sure there's some comparable cities right along the border. I know we have South Bend, and we have like Michigan City and a few others. I can't remember what Michigan has, but there is one difference. Us in Illinois. Illinois does not have a reciprocal agreement with us because we have no comparable city to Chicago. Chicago draws a lot of people over from Indiana. Indiana does not draw the same amount of people back from Illinois. And so therefore, Illinois would be missing out on taxes because they're losing all those Indiana people that come over, but they're not getting a lot of, they're not themselves losing Illinois people that are coming to Indiana because there's just not a comparable size city by any means. You can see here are the states that we have reciprocal agreements with. It's kind of odd that that these two are in there, Pennsylvania and Wisconsin, since we don't touch them, but they're still there. You can see back here, it was in 1998 when the reciprocal agreement was disbanded between Illinois and Indiana. So in that case, people up in Gary, Hammond, East Chicago, they're going to have to file a state of Illinois tax return as well as an Indiana return to balance out to make sure they've paid enough. So they're actually going to have to file two state returns just because there's no reciprocal agreement. People up in those areas typically know those rules a lot better than anybody else in the state of Indiana, except if you live in the very Northwest, like Lake County. It's just not something you're going to have to really be too concerned about. All right, non-resident income. So you can this would be for anybody that goes into another state and works and makes money and then comes back to their house, their main home. Or a lot of times this would happen if you move. If you move throughout the year and you made some money in, say, Georgia, and then you made some money in Indiana, you're gonna have to file two returns. Where you live right now, say Indiana, you would file a normal state return. And then you would file Georgia return for the amount of money you made while still living in Georgia, and you would fill out a non-resident return. So let's get to this professional athlete, and I would definitely recommend reading through this. I'm not going to read through all of it with you because you can do that yourself. But basically what's happening here is we have, in this case, a big league pitcher, works in Texas. Texas is one of those 9 states that does not have income tax. And so therefore you think, okay, I play for whoever it is, let's say it's the Houston Astros, but you think, okay, I don't have to pay, I don't have any taxes for state purposes, and that would be incorrect because you actually are playing in different cities. You're going to Chicago, Illinois to play the Cubs. And so what most of the time, and it all depends on each state has their own special rules on these situations, but a general rule of thumb, an average on most states is you're going to split up your wages and divide it over the number of hours or days that you actually worked in that state compared to the number of hours and days that you worked in total. And then that's how much is going to go to each state you're going to put on the return. So you could easily have 9, 15, maybe 20 state tax returns as a professional athlete. So that's almost all professional athletes would have their own accountant, just because it's going to be a lot more work than just your average employee. So read through that. I thought it was pretty interesting. Our last item here, the Indiana county tax. You do have to file a form for Indiana county taxes when you are the employer as well. Employer is going to fill out this BT1 to says, hey, we're a new employer in the area. And then they're going to then let you know by giving you these other forms, how often you need to pay your tax to the Indiana and county. And so just know that those are forms that you have. All right, that's gonna do it for part 1 of the state and local taxes along with your W-2. So we're going to cut off here and we're going to jump in part 2 with the fair tax. And I think you'll find it interesting.